new data or to have new insight on the performance of the company. Then we will cover the assessment of future perspective of the company's performance. And the last thing that we will discuss, it is the key performance indicators, and also what is mostly in the recent years being discussed and introduced in financial statement analysis, it is alternative performance measures. These latter indicators are not audited or are not regulated, so be aware when you use them in your analysis, because usually they take into account financial and accounting data that is not subject to auditing. So be careful when you read financial statements and you read these kind of indicators. Usually the management will put a lot of emphasis on these indicators, but very often they try to put the company in a better light than it really is, and this is an intention. It is an intentional movement from the management. Okay, so this is the contents and the topics that we are going to cover together. What about the learning assessment method? I think that you are already informed about this part from Professor Busso. We will have the same proportions. You will have 60% of your grade related to the exam, and you will be provided with previous exams, so you can know the structure, how many exercises, if there are multiple choice questions or not, and so on. So before the final exam, we will have some information about previous exams, so you know the structure. You also already know the date of the final exam. It is, if I'm not wrong, 9th of November, and it will be in the morning. Again, if I'm not mistaken. Then 40% of the grade, it will be related to the group work project. Some more detailed information about this. You will be working with the same groups and the same companies. That's the first part. So the members of your group will be the same, the company will be the same. You will just continue your work with the topics that we are going to cover in the second part. I mean, in the first group project, you didn't discuss about inventories, you didn't discuss about the cash flow statement. You are going to discuss that now in the second part, and moreover, you are going to calculate the ratios for these companies. Some of the ratios, well, I can understand that there is a lot of discussion, but please ask me if you want to ask something. What I was saying is that you will calculate the ratios for your companies. Some of them are already published as part of the annual report. You can read them. For example, earnings per share, or return on investment, return on assets. They will be there in the annual report. You will find them already calculated. But you have to interpret them, and you have to be objective in your interpretation. Okay? So this is some information about the second part, the assessment that we will use. Any question regarding the topics, regarding the contents, regarding the organization? We also posted on Moodle the deadline for uploading the second part project. As we will have on 5th of November the presentation of the second group project, the deadline will be 4th of November, okay? It is on Moodle?
So,
yes.
The presentation is before the exam, yes?
Sorry?
The presentation is before the exam.
Yes, the presentation is before the exam. And something that I can say is that based on previous experience, what you prepare for the group project is basically the same stuff and knowledge that you will need for the final exam as well. For example, you will calculate ratios for your companies, and the focus of the final exam will be the same, calculating ratios for other companies. So it's not like something separate that you have to do two different things. It is the same knowledge that you have to apply to two different objectives. One for the company that you have to analyze deeply, and one for the short exercises that will be part of the final exam. So yes, the presentation of the group project will be before the final exam. Okay? Any other question? Let me check if there is any question in the chat. No questions so far? So we are all clear what is in the future for us?
Presentation.
Okay, can we start then with the presentation for the lecture today?
第二份都要开始了，4号就要交presentation，对，然后5号是周五，然后那个 presentation 就是做小组作业，然后9号考试。这项呢，第二部分我觉得不一定那么难，他不是说没那么难。太低了。你知道为什么我觉得人很尴尬吗？今天我在单位的时候上学，然后我同事要看他的那个照片，我就给他看了ins，同事手欠，直接给我点了like，在他之前的那张照片。
Not a very difficult standard to start the presentation of the second part. So it is the IS2 inventories. It is considered not a very difficult standard. It is a fairly short one. If you check the standard itself, it will be like 10 pages, not longer than 10 pages, but you will find that there are a lot of exercises attached to the inventories. What items are included in the cost of inventories and how we can calculate cost of inventories. So we will explain theoretically all things that cover the inventories, but we will also cover several exercises in the next tutorial. The next tutorial is not tomorrow, but the day after tomorrow, afternoon, and we will proceed like this. Usually I will try to upload in Moodle the slides beforehand. So one day before the lecture, you'll have the slides uploaded in Moodle. So you can see and read what we have to cover for the next day. And maybe you can come with questions ready if you want. If you don't want, that's fine. You can just come here unprepared and listen. That's fine. We will also do the same about the tutorial exercises. I will post them beforehand on Moodle. You can see what exercises we will cover during the tutorial hours. And then I will upload the solutions. We will try to solve everything during the hours here in class, but then I will upload the solutions. Does that work for you? Okay, thank you. So we can start with the presentation of the IS2 inventories. As I said, this is considered a simple or a basic standard, but still regarding the application in different contexts, there may be some difficulties. So please feel free to ask if you have any question. What we'll discuss about this standard or the learning objectives. Okay, we will try to explain the composition of the inventories. We will describe 5 assumptions that we have about the inventory cost flow. And these assumptions, some of them are very famous, maybe you have heard of them, FIFO method or LIFO method, which by the way is not a known from IFRS. But there are also other assumptions. Overall, there are 5 of them, and we will present and discuss these assumptions. Next, another objective is to show the effect on annual profit and profit trends of using different inventory cost assumptions. We also have 5 options, but not all of them are considered the same. So we have to think very well which one to use, because this will have an effect and impact on the financial result and the total of the balance sheet. Another learning objective is to discuss the standard requirements relating to disclosures of inventories. And the contents are also connected, I would say, with the learning objective. Something before I start explaining. Inventories is considered a very easy standard, but on the other side, Please be aware that inventories is one item of financial statements that it is very important for most of the companies that you will be working with. So being it an industrial company, merchandising or manufacturing company, they all have inventories. And some of them will have the inventories item one of the most important items in the balance sheet. So even though it is quite easy to understand the things and items about inventories, it becomes really very important for different companies in application. And something else that I have to mention about inventory is the fact that if you slightly change the method of measuring inventory, you'll have a huge impact on two very important items in financial statements. First is cost of sales or cost of goods sold. If you change the cost of inventory, you will change the cost of sales. If you change the cost of sales, you will change the financial result, net profit or net loss, and sometimes companies use this method to perform the accounting cosmetics that we mentioned before. So it is important. And the other thing is that by changing the amount of inventory, you can overvalue the inventory and increase in a faulty way or in a false way the total assets in the balance sheet. So it becomes a big problem. It is an easy standard, but as it is related for a very important item in financial statements, the practice has shown that many companies will misuse the liberty or the freedom that the standard has allowed to them. That's why we have to be very careful and to read and understand really very well what the standard allows and what does not. Okay? So this is just to explain why it is important. Something that we have to mention is that usually the commercial companies will include in the valuation the goods that are purchased for resale. That is, inventories are different for merchandising companies and for manufacturing companies. Usually the commercial companies or merchandising companies will find inventory under the item goods and merchandise. They are reported with their cost of purchase, whereas the manufacturing companies, usually they will report inventory under one of these three items that you see over there. The manufacturing companies do not buy goods for resale. They buy raw material to produce a finished product. So as their intentions or their focus and their daily work in the business is different, also the inventories items will be different. When you analyze commercial companies, for example, one group has, I think, Carrefour company to analyze. When you analyze Carrefour company, you will find goods and merchandise. Because it is a merchandising company. But if you analyze, for example, Peugeot group, you will find three different inventory items. That is raw materials, it is the first one. It is material that are going to be used in production. They are usually purchased and kept in storage until the time comes to invest or put them in the manufacturing process. Usually the raw materials are to be found in a separate warehouse where the raw materials are usually kept. Okay? Then the next item is work in progress. Usually they are products in intermediate stages of completion. Physically, you will usually find work in progress not in the warehouse, but in the production floor. If you go in a company that is manufacturing something, usually when you go into the production floor, in the manufacturing room, in the plant or factory, call it whatever you want, you will find many items being produced and manufactured there. This is work in progress. It is not kept in a storage room or in a warehouse, but it is usually found in a manufacturing production floor. And then the next item of inventory is finished goods. The finished goods are completed products, and they are usually kept in a separate storage room, waiting to be delivered or shipped to the final customers. Usually companies try to minimize the amount of the finished goods kept in storage because it has a lot of cost for them to finish production and just to put them in the storage or warehouse and to wait for the customers to deliver these products to them. Usually the companies, especially in the modern business factory facilities, use the just-in-time method of production. Maybe you have heard about just-in-time. In the just-in-time process, they usually don't start production until they have an order from the customer. And in this way, there are minimized the costs of inventory, either the raw materials or the work in progress or the finished goods. Okay, so these are three different items. Any questions so far? Mm-hmm.
And in the goods and merchandising category, when we stated that it's cost of purchase, it's kind of hidden cost. We calculate it in the final product. Yes.
Mm-hmm.
That's it. Yes.
So your question regards the goods and merchandise.
Yes.
They are reported with their cost of purchase. These are related to the commercial companies.
Yes.
That means that usually these companies do not produce anything. That they buy and they resell the same thing, usually changing nothing, even not changing even the packaging sometimes. The same thing is, I'm not sure if I understood your question, sorry.
Oh, how can I say? It's kind of internal cost.
Internal?
Yes. In the companies, when they want to report it.
Okay. The question of the student over here relates to the cost of purchase of goods and merchandise, if that is an internal cost. No, that is not an internal cost. Actually, it is really very verifiable because it relates to the cost that you have paid to purchase this merchandise and goods, and also includes the cost of transportation, the custom, and everything that you pay until the merchandise has arrived to your warehouse. We will cover this in detail a little bit later, but your friend over here was asking if the cost of purchase is something internal for the companies. No, it's not internal. They do not decide what the cost of purchase is. They calculate the cost of purchase based on very objective data, like the purchase price from the supplier, the transportation cost to bring things from the supplier to the company, the custom or excise that should be paid. But we will cover this in detail later. Your question is really good, because if you read the IS2, they have a special paragraph. I will give you the reference later. They have a special paragraph about the cost of purchase, how we can assign this cost. Usually the merchandise companies like Carrefour, I mentioned Carrefour, they trade like tens of thousands of stuff every day. And it's not very practical for them to calculate the cost of purchase like I mentioned. What is the purchase price plus the transportation cost and so on. Usually what they do is that they refer to the reselling value, that is the selling price of the products, and they deduct or subtract profit margin that is useful or common in their sector. This is usually a practical way for big companies like Walmart or Carrefour to value their merchandise, because they have tens of thousands of items with tens of thousands selling and purchasing every day. It's not very practical to keep every item and to calculate the cost for each of them, okay? But still, I will give you references about this later. These are the kind of inventories that when you look at different companies, you may differentiate between them. You may recognize which company is a merchandising company and which one is a manufacturing company. Even if you don't know what they do, if you go at the balance sheet, current assets, inventory section, and if you read this name there, goods and merchandise, you understand it is a merchandising company. If you read instead raw materials, work in progress, and finished goods, you understand that it is a manufacturing company, okay? We said that there are several assumptions related to the flow of cost. What does that mean? When we sell the inventory, the question arises exactly what item of inventory we have sold. We mentioned Carrefour, right? Now Carrefour is a super big company. When we sell some rice or some pasta, exactly which package or which item did we sell? that becomes a little crazy, right? So we need to put some assumptions in place in order to have it more clear for us to calculate the flow of cost. Why is that so? Because the merchandising and also the manufacturing companies purchase the merchandise or purchase the raw materials at different prices. And usually the prices in the market either goes up or down. Usually they go up all the time. And as the prices go up, usually, how do we keep the track of the items that we sell? Have we sold the items that we have purchased last year with a lower price? Or we have sold the items that we just purchased 1 week ago with higher price? So this is the idea behind keeping track of the inventory flow. And as we said, we have 5 main assumptions. The first one is the unit cost. We will explain it in detail in the next slide. But basically what unit cost implies is that according to this assumption, I will keep separate data about every item of inventory that I resell or manufacture. It is not very practical for most of the companies. It may be practical for Peugeot while manufacturing their vehicles, but not for Carrefour while reselling the pasta or the rice, okay? Therefore, we have some other assumptions more practical to use, like first in, first out. I think that none of the accounting students go out from the accounting course without learning the FIFA method or the LIFO method, so this is something that you will keep in your mind. The weighted average is a more useful method that it is really very easy to carry out using accounting information systems, that is software that make the calculations actually easy for you. And the last one is the base inventory. The last one is the least famous or popular. Maybe it's the first time that you hear about that, but it is mentioned in IS2, and we will explain a little bit about that. So, which one is the best for each company? In the unit cost assumption, the first one, we assume that we can identify the actual physical units that have moved in or out. Now, you understand that this is not the case of many companies. This is a special case for very special companies. For example, those companies that produce or manufacture according to the requirements from the clients. This is known as individual job production. We expect the clients to put an order with their specific identification and features, and we produce something according to their requirements. And this is where the unit cost assumption becomes really important and really very useful and practical, okay? So each unit must be individual, distinguishable, maybe through a serial number, and is not interchangeable. For every item of inventory, we open a specific document that we keep track of the costs that are related to this item of inventory. Again, it makes sense if I'm producing a special vehicle according to the requirement of a special customer. They want customized features in their order. But it is not very useful if I'm reselling rice or pasta. It's not useful to open separate documents to keep track of the cost of every package of rice or pasta, right? So the unit cost assumption works for those companies for which it is important to keep track of individual and specific information for specific items of inventory. It is impractical, as we said, in most cases, because we simply add up the recorded costs of those units sold to give cost of sales and of those units that are left to give stock. I inserted a question over here at the end of the slide, but as we already answered that question, I think that it is clear what company may consider to use of a unit cost of inventory approach. Those companies that produce or manufacture according to the requirements or orders from specific customers. There are many companies that work according to the specifications and they produce customized products, these companies may choose to use the unit cost. It is also known, don't forget the other name, specific identification. That is, each item of inventory is kept separately. Whenever you spend something or make a cost, you put that on that item. You charge this expense on that specific item of inventory. Now, as you can understand, this is very time consuming. It requires very attentive workers and accounting information system. And because it is not very practical for most of companies, we have other methods that are very easy to use. Okay, we have a test question. Now, usually I insert test question in the slides. This is not a surprise right now for you because the slides were already uploaded in Moodle. You can find it there and you can find the answer to this question there. But usually these test questions have been questions in previous exams. For example, this test question has been part of the exam last year. You can know what to expect regarding the multiple choice question at least, okay? For example, which of the following is not an inventory cost assumption? Base inventory, we mentioned that it was an inventory cost assumption. Unit cost, we mentioned that as well. Interchangeable approach, that is not a cost assumption. So, alternative C is the correct answer. Again, these test questions are not to get you in a surprise because the answers are already uploaded on Moodle, but just to make you think and apply what you have already heard during the previous minutes, I mean. Okay.
Sorry, teacher, can I ask?
Yes?
I want to ask the base inventory. Can you explain that
Yes.
again?
We will explain the base inventory later. We are not completed with the assumptions of cost. We started with the first one, the specific identification, and we will continue with the other methods. Okay? We have an illustration example for the next three methods. They are actually very similar to each other, except that they change the way that the inventory goes out. The FIFO, LIFO, and weighted average. In order to illustrate the calculations for the three methods, we will have the assumed transaction for a company. This is an example that you also have in the textbook. I think that you have all been provided with a full textbook. Okay, so whenever you check the material, you will find the same example. Later, when we finish the theoretical presentation of this standard, we will have an exercise, a new exercise, regarding the FIFO and weighted average method. So, what is in the slide right now, you also have in the textbook. Later, we will open an Excel file, Excel spreadsheet, and we will solve or calculate, calculate the cost based on the FIFO and average method, okay? So this is why I'm just skipping through the slides, because it is a solved illustrative example that is also in the textbook. Later on, we'll have more time in Excel to illustrate how to calculate the cost through FIFO and average method. Once again, we are assuming this transaction for a certain hypothetical company. Purchases have happened in January, February, and April. You see that the context of the situation is one in which we have consistently an increase in the prices. In January, we buy at 25 euro each item. At February, the purchase price goes up at 30, and then we have a further increase in April at 35 for each unit. Okay? Then we have the sales. In March, we sell at 50. This is the selling price. This is not the cost of the items that we have sold. This is the intention. Through using this method of cost flows, we want to calculate, okay, I sold 15 units and The price, the selling price, is decided by the market, demand and supply, economics over there, and the price is 50. But how much did it cost to me? How much was the cost of these items that I sold? This is the idea, and this is what we need to do in accounting. And then in May, we sold 18 units. The purchase price was up, but again, this is something that has to do with economics. Demand and supply in the market. How much did it cost to me to buy or purchase or produce or manufacture these 18 units that I sold? So this is the idea behind using an inventory cost flow assumption. Okay, let's start first with the FIFO method. I know that for most of you it is familiar, at least for those who come from an economic background. You have previously studied maybe economics or accounting, and you know what FIFO is. It means first in, first out, and that means that what is purchased first will be sold first. The units remaining, that is the ending inventory, the inventory at hand at the end of the period, will be regarded as representing the latest units purchased. Once again, in FIFO method, we assume that we sell the earliest units, the units that we purchased first. That means that when the period is over, what I have left in the warehouse are those units of inventory that I purchased last. Logically, that makes sense, and it is very acceptable considering many companies. Usually the companies that sell food or sell drugs or sell pharmaceutical drugs in the meaning of pharmaceutical items, usually these companies find the FIFO method very useful and very practical for them, because they have to sell their stuff within the due date or within the expiration date, the expiry date. And that means that I have to use the FIFO method because it resembles the actual physical flow of inventory. I don't know if that's clear for most of you. So FIFO method makes sense, it's logical, and it relates to the reality of many companies that operate under expiry dates or due dates for their inventories. For example, food, or for example, pharmaceutical companies, they have to sell their items according to their batch production or their batch purchases, which is what is purchased first has to be sold first, otherwise it will go obsolete and I cannot use it anymore. Okay? So that means that under FIFO method, which really makes sense and it's logical, what I find at the warehouse at the end of the period is those items that I purchased last. It is the latest purchases that I have made. And that is really acceptable and logical by all means of accounting principles or accounting rules. Once again, you have the data there, what you purchased in January, February, and April, and what you sold in March and May. What about the calculations? What we sell in March, 15 units, they are considered 15 units that are sold at 50 each. That is, they bring 750 euro as income. And 18 units that I sell with the price 60 euro each, they bring income 1,080 euro. Altogether, the two together, the income is 1,830 euro. But what is the cost of these items that I have sold? Now, considering the purchases and their specific prices, that means that the 15 units that we sold in March are the same 10 units from January and 5 units from February. And then 18 units that we sell in May are units left from February and some of them purchased in April. This table over here, once again, all the calculations are in the textbook. That's why I am just skipping through them, because later we'll have an Excel illustration regarding the same method but with other data. If you see all the calculations over here, it provides the details that I mentioned. So what you are selling in March, it is 10 units from January and 5 units from February. And you see here with blue, the blue color, are the calculation of cost of sales or cost of goods sold. Once again, the assumption here is that when I sell 15 units, I will start from the first. What is the earliest items that I have in inventory? The earliest items is what I have purchased in January, 10 of them at 25, plus 5 units from the purchases of February at 30 euro. Now, if I'm here at the end of March, what I have left in inventory, so the ending inventory in March is only 10 units. And these 10 units are those that I purchased last in February with 30 euro per unit. And therefore, this is why the value of inventory at the end of March is 300. If the story continues, because the accounting year does not finish in the end of March, the story continues. With April, in April we purchase some other units. We purchased 20 units at 35. That means that by the end of April, the ending inventory is 30 units in physical units, but what about their value? The value is 1,000 because 10 units are purchased at 30, whereas 20 units are purchased at 35 euro per unit. Then when May comes and we have to sell 18 units, we start again from the earliest that we have in inventory. What do we have in inventory, by the way? Remember that we have left 10 units from the units that we purchased back in February. So we sell them first, these 10 units, with 30 euro per unit as a cost. And then we start to sell what we purchased in April. 8 units at 35 euro per unit. You see that actually this is a simplified example. What really happens in a company like this is that they purchase every day 2, 3, or 20 times a day, and they sell each day from one unit only because they may have 100 or 1,000 different items of inventory. This one relates only to one item of inventory, and imagine the volume of transactions in and out every day for thousands of items of inventory becomes really very difficult to manage manually. Luckily, there are accounting softwares that do this for you right now. This does not mean that you don't have to learn how they work, because otherwise the artificial intelligence will take over. We have still to understand the logics, how the accounting software works, how they keep track of inventory. In case there is an error, a logical error, sometimes in accounting softwares, we can understand that, okay? So it's not that this stuff now is taken over by accounting information systems, and I don't have to think, I don't have to learn about these methods, okay? I don't know if that is clear or needs some more clarification, some more explanation. Again, the idea behind the FIFO method is to keep track of inventory. What you purchase first, this is what you will sell first. What you have left, this is what you will sell when the next sale happens, okay? It needs a little bit of concentration to follow the inventory flow, but other than that, it's not difficult, it's not complicated. The FIFO method. According to the FIFO method, we can also calculate the profit. What we mean by profit is the gross profit. Now, be aware there are several levels of profit in the profit and loss statement. You have gross profit, you have operating profit, you have net profit, you have retained profit earnings, and so on. I'm referring only to the first level of profit, which is gross profit. The gross profit is the difference between sales and cost of sales. The gross profit is very important to facilitate the comparison of companies among each other. Usually when you analyze different competitors in the same sector, you will start by comparing these companies through their gross profit or gross margin. It is very important because gross margin or gross profit is not impacted by other operating or financing costs. It is impacted only by how much you get from selling, how much you have spent to produce or to buy what you have sold. And it's a very pure result. It's not mixed with other stuff like operating expenditure, depreciation, or finance costs and so on. I don't know if that's clear for most of you. So gross profit is very important in analyzing companies and comparing competitors between each other. Why? Because it is a very pure result. It is not impacted by costs such as depreciation or big salaries or costs like finance. A company may be better than its competitor, but only because it has received many loans and it pays a lot of interest, it may have net profit lower than its competitor. But otherwise, regarding the operating activity, it's better. And how we understand operating activity? It is through the gross profit. I apologize because I extended the discussion. I just want you to understand the gross profit is important not only to disclose in the profit and loss statement, but also to use in analysis, okay? Now, we calculate the gross profit for FIFO method by deducting from sales the cost of sales. How many of you have previously maybe learned how to calculate cost of sales? I think that you took a pre-accounting course, something like this. Did you cover there the way of calculating the cost of goods sold or cost of sales? The inventory equation? Or maybe something that you know from previous bachelor studies? No. Okay, I'm assuming no. And I apologize for those that already know this. Now, we calculate the cost of sales through what we know as inventory equation. Inventory equation is inventory at the beginning plus purchases less inventory at the ending. It's equal with cost of sales. This seems like something very easy. Now you remember, right? It is something very easy actually and very familiar, but the inventory equation is a tool for control. You can not only calculate the cost of sales, but you can also control the inventory level through this equation. Once again, opening inventory plus purchases less closing inventory, this equals cost of sales. Why that is important is because it's like this equation should always be true. In case you want to make a physical count, you have to check if the physical items in the warehouse really match with the accounting level. And if they are missing, guess what? Something has happened. Some of the employees may have abused their power or control into the warehouse. So the inventory equation is really important, not only to calculate the cost of goods sold, but also to keep control of the inventory at hand, of physical inventory. Has it become obsolete? Has it been destroyed from some fire or something? Or has it been abused or stolen or misappropriated by some not responsible employee that you might have? So be aware of the inventory equation. It's a control thing. It's very powerful too. Yet here we are not talking about control in a company. We are talking how to use the inventory equation to calculate the cost of sales. And you see here that we take the purchases and we deduct the closing inventory because the opening inventory of this company is 0. As the opening inventory is 0, there is no line over there for opening inventory. We directly start with purchases, we deduct the closing inventory, and therefore we have calculated the cost of sales. Okay, maybe I'm too late to check the chat. Can you hear me from your homes or offices? Can you please write something in the chat? Okay. That's okay. Sorry if I read your comments or questions late, okay? So right now we calculate the gross profit with the FIFO method. Okay. Another test question for you. Again, this is something very simple just to give us a break and to make us think. In case we fall asleep or the lecture is very boring, we have these test questions inserted all the time. Expect this to find in all our lectures. Under the FIFO inventory cost assumption, the entity assumes it sells the units that it purchased first. The entity assumes it keeps in its inventory the units purchased last. The entity assumes the units are interchangeable and not specifically identified. Actually, we know that it is all of the above. So all three statements are very useful to describe FIFO method, okay? Now, what is the LIFO method? LIFO method basically assumes that what we purchase last will be sold first. Can you think of a company that may find LIFO method useful? This is a question out of the slides. Can you think of a company that maybe will find the LIFO method useful? What is purchased last, I will sell first. It doesn't seem very logical, but maybe some company may find it useful. Remember, the methods that we are mentioning, please remember this thing. The methods that we are mentioning does not mean that actually, physically, the inventory is moving like that. But this assumption really fits best what is going on. Actually, in reality, this does not mean that I really keep track of the lots and batches of production to sell them fast, first or last. It only means that what I assume as inventory cost flow matches best with what the company operates with. This is the best match or the best fit. Does not mean that actually this happens all the time, okay? Now think of some company that may find the LIFO method useful or practical or I don't know. Do you find that method very logical? During the classes we can discuss, you can make mistakes during discussions. You cannot make mistakes in the test, but when you discuss, feel free to make mistakes, okay? You are in time to correct yourself. So, can you think of a company that find the LIFO method useful? Okay. Alessandro is asking in the chat, thank you for your opinion. Every company that sells products influenced by inflation and fashion company, really interesting. Elena is saying fashion company? Okay, maybe. Actually, what happens is that what is in fashion will sell fast. Then yeah, that will make work. Thank you, Elena. Very, very good thought. Anything else? Usually this works for those companies that work in the natural resources sector. They mine the ore and they put it in the ground, and usually what they put on the top will be extracted first, if you know what I mean. So usually this flow cost net assumption works for the mining companies or other companies that work in the natural resources sector. They mine the ore, they put in the field, what they extract from the ground last is on the top of the big pile over there, so it will be sold first. So this works, but this is a very specific case. It's not the most companies that use the LIFO method, and actually, if you think more, LIFO method makes you keep in inventory, in the balance sheet, those items of the inventory that have been purchased at the earliest periods. Basically, for a company that has been operating for 20 years, using the LIFO method means that when we check the inventory in the balance sheet, I will find there items that I purchased 20 years ago. If we follow the LIFO assumption, is that a good assumption? By the way, no. Inventory is a current asset. And as a current asset, I have to sell it, I have to circulate it within 1 year. So LIFO method is not logical It's not practical, does not apply to many companies, and actually is contra-logical. Okay? But why is it allowed? By the way, IFRS do not allow the use of LIFO method, but the US GAAP allow that. Why? Only because of fiscal or tax relief. Many companies in US will use the LIFO method only for their tax statements. They will abide with another method, FIFA or weighted average method, to prepare their financial statements, otherwise to be reported in the stock exchange and so on. But when they report to the IRS, Internal Revenue Services, their tax authority, they will use the LIFO method because it gives them a tax break. Why is that so? Through the LIFO method, you can calculate a higher cost of sales. Because you sell the items that you purchased last, they have a higher purchase price. If you include them in the cost of sales, that means that your cost will be higher, your profit will be lower, you will pay less taxes. So it's a practical solution. It is allowed only to give some relief to companies, but it's not logical in the meaning of accounting or financial reporting. Okay? Now, if we continue with the LIFO profit, we will see the same calculations. The gross profit will be lower compared to FIFA method. A little bit later, we'll have a slide where we will compare the three methods, FIFA, LIFO, and weighted average, and then we can see the differences actually between the three methods. Now, what is the weighted average approach? This is a method that is widely used by many companies. Actually, the majority of companies, if you make a research and you check for your own companies in the group work project, you will find that many of them use the weighted average. The weighted average means that each time you buy or purchase a new batch of products, you will calculate a new average cost of inventory at hand. We will use the same data to make the calculation, and what we'll see here. We start with purchases at January and February, as you'll see. And then by the end of February, we calculate the total cost of inventory at hand. This means that the total cost is €700, but related to 25 units, that means that it is a cost of 28 euro per unit. That means that when March comes and I have to sell 15 units, I do not keep track anymore. Oh, okay, these 15 units are 10 units from beginning and then 5 units from... No, it's not necessary. When you sell 15 units, you calculate the cost of sales using the weighted average cost. What is the weighted average cost? This 28 here that has a small sign asterisk there. 28 is the ratio between 700, the total cost, by 25 units. If you divide both of them, you will have 28. Actually, you can also see that it is like an average between the two purchase prices. One batch you have purchased with 25, and the other batch you have purchased with 30. If you make an average, but not a simple average, like in mathematics, but weighted average that keeps in consideration the number of items and units in each purchase, you will find a weighted average like 28. Again, is it clear how is it calculated? The workings are here. In April, you buy another 20 units at an even higher price, which is 35 euro. And then when you buy, you have to recalculate the average cost in inventory. Every time you buy another batch of units, this changes the average price in the warehouse, and you have to recalculate it each time. Now that we purchased in April, at the end of April, we have to recalculate another weighted average cost. We have like 980 euro of inventory and divided by 30 units, that means a weighted average cost 32.67. The workings are here, again, at the next slide. Basically what's happening is that each time I purchase a new batch of inventory, I have to recalculate the weighted average cost. Again, you can understand that this takes a lot of time. Practically, if we are in a company that recalculates the average prices of inventory each time we buy something, this will take a lot of time. But luckily, again, there are accounting softwares that do all the calculations. Because I may have many ins and outs of inventory, and I also may have many items of inventory. Everything is kept track with through all accounting information systems. Now, what I wanted to show you is another approach, which is base inventory approach. We had a question some months ago from one of your colleagues here. What does that mean is that sometimes the companies keep like a level which is a certain minimum of inventory which is necessary in order to remain in business. Many companies need a reserve of inventory, if we call it like this. This is the base inventory approach. In order to perform my operations, I need to keep a minimum base, a minimum level of inventory. In case I have no raw material in the warehouse, imagine for a manufacturing company, if they have no material, zero raw material, they will stop the manufacturing process. That is why many manufacturing companies have a minimum desired level of inventory, and this is the base inventory approach. It makes sense for these companies. It can be argued that some of the inventory is really not available for sale and should therefore be regarded as a fixed asset. That means that through this approach, some kind or some level, some reserve of inventory is not part of the current assets at all, but actually is reclassified at the bottom part of the assets as part of the long-term assets or non-current assets. Okay? The minimum level remains at its original cost, and the remainder of the inventory above this level is accounted for as inventory by one of the other methods. Regarding the base inventory approach, we will not have exercises, only theoretical knowledge. What you need to know about the base inventory approach is only theoretically. What does it mean? It means that I have to keep a minimum balance of inventory, and as I cannot use it or sell this inventory, basically, it's not a current asset. I have to reclassify into the non-current asset. Okay, if I do this move, if I reclassify this inventory as part of non-current asset, at which cost will I do this? At the purchase cost. Whereas the other levels of inventory, the other units, the other items, will be accounted for through FIFO method or weighted average method. Okay? So once again, base inventory approach is special for some companies. It will not be asked from you to know through exercises, only through theoretical knowledge. This is an illustration only for the base inventory. If we consider that the minimum required level of inventory for our company is 10 units, this means that what I find in the warehouse at the beginning of January, that is, the 10 units will remain there. I will assume it's not even there. I will make all the calculations with only what happens later in February, what I purchase, what I sell, and then what I purchase again in April, and so on. So what I find in January, it will be left there. I will not touch it. I will make calculations through FIFO weighted average only through later transactions. Okay? What I wanted to show here is a summarization of the results of different cost approaches. We have FIFO method, LIFO method, weighted average method, and base inventory method. What is really important to see is that actually the purchase cost and the sales revenue does not change. This is not something that I can change as a company. What I sell, I sell. This depends on the selling prices. The selling prices are decided from the market. Okay, I have my own word, but actually the market decides how much will I sell the products. And also the purchase cost, this is not decided by me. This is decided by my suppliers. How much do they sell the product to me? So again, in all the cost methods, the sales income and the purchase cost are the same. What changes though is the closing inventory. And you know that the cost of goods sold or cost of sales is the difference between purchases and closing inventory. In those cases when opening inventory is zero, as it was our example, the cost of sales is basically the difference between purchases and closing inventory. Now you see that as closing inventory changes, this will have an impact on cost of sales and also an impact on profit. Do you remember what we said at the beginning of our lecture, why inventory standard is important? It is important because through impacting the cost of inventory, the company may have an impact on the number of the total assets through the inventory item, and moreover, may have an impact on the profit. And this is very important for companies that want to manage their profits or manipulate their earnings. How can they do that? Well, by a simple change in the inventory assumptions. They are not violating any standard, they are not violating any laws, but by simply changing the inventory cost flow assumption, they may impact the amount of their earnings. So this is why inventory calculations are important, okay? Now you can see something else as well. The weighted average method over here gives you an amount of profit that is somewhere in between the profit that is calculated by FIFO and LIFO method. You see, FIFO gives you a profit of 850. Why is that so? Because remember, we are in a condition or in a situation when prices go up. Usually we have a very slight inflation. That is the reality in most of the markets, in most of the times, in most of the world. Very steady inflation. From 2 to 4% a year, it is acceptable and really healthy for economy. Okay, so you expect prices to steadily rise up and increase. What happens in these cases? In these cases, you will have a profit from FIFO method higher than a profit from LIFO method. Again, remember, LIFO was allowed for tax relief, for tax incentives. Why is that so? Because it gives you a lower profit. As you have a lower profit, you pay less taxes. But again, this happens in US and not in Europe, not under IFRS. Okay? You can see that the weighted average gives you a profit. I'm repeating myself, something in between the profit from FIFO and LIFO method. Whereas the base approach actually gives you the same result as LIFO, because basically it is assuming that what you have purchased first, you are not touching that at all. It will remain there and you will not change anything through that amount of inventory. Any questions so far? I know that I took a lot of time to explain something that may be regarded simple, but again, this is important not to technically know how to calculate or to make the calculations in FIFO or weighted average method. But it's important to know what happens in the financial statements themselves when we have increasing prices or decreasing prices. By the end of the lecture today, we'll have an Excel illustration with the case of decreasing prices, not inflation, but deflation. What happens then between different methods, okay? We have another test question. Let's see. LIFO cost assumption will yield a lower profit. Always. It's only before 1 minute that I said that, so maybe you remember. Okay. if the economy experiences periods with price increase, LIFO method means that I have to calculate the cost of sales with the highest prices, the recent prices, which are higher. And that means that the lower profit will be exactly in these situations. Do we need to repeat it or is it clear? Okay. Any question?
In case of FIFO, it's C.
Yes, in case of FIFO, it will be when the economy experiences deflation or decrease in price. Okay, another thing that we have to discuss about inventory is the inventory systems. What is an inventory system? How we record the physical inventory at hand. Actually, we know two different inventory systems. One is periodic inventory system, and the other one is perpetual inventory system. Any of you know how to explain each of them? It's basic, it's very simple actually. What is periodic inventory system and what is perpetual? If I may help you, many years ago when we didn't have computers, we could not perform all the calculations needed by the perpetual inventory system and we were forced to use only the periodic system. What does that mean? What is a periodic system? Yes. Thank you.
With the periodic system, every 3 months, 6 months, or 1 year, you check how much products or stuff do you have in inventory. And with the other system, you keep track of every unit sold and bought, so you can always know how much stuff do you have.
And that is correct. In the periodic system, you have to physically count how many inventory do you have at hand. Imagine in the 50s of the last century, you didn't have any computers, and you sent your employees in the warehouse to count in your shelves how many inventory do you have of each item. That was very time consuming, as you may understand, one, and B, the other thing is that you never know how much inventory you still have. You have to check periodically. Go and check in your warehouse. Do we still have from this item of inventory or we have to order? Why? Because we do not have a system to keep track in a perpetual manner. Whereas the perpetual inventory system, we keep all the data there and every time we know how much inventory we have at hand. This is described in these slides. In the periodic inventory system, inventory is determined by a physical count. As long as the count is made frequently, it's not necessary for us to maintain extensive inventory records. Now, through this system, the inventory that we show in the balance sheet is determined by the physical count and is priced in accordance with the inventory method that we use, FIFO or weighted average. So basically what we do, at 31st of December, we go to the warehouse, we count how many inventory do we have, and we put a price on this inventory according to FIFO weighted average. Basically FIFO, because weighted average is difficult to apply with periodic inventory system. You can imagine how much time consuming this is and how very non-practical it is for the modern business companies. And therefore we have already using the perpetual inventory system, which are facilitated by an accounting information systems. They are not difficult to perform. Perpetual means that you have an item or you have a document, let's say, where you keep an eye for every item of inventory, how many units do you buy each day, and how many units do you sell every day, and how many units do you have at hand at the end of each day. And if you want, you can check the level of inventory many times throughout the day. Actually, the automatized accounting information systems, they have a connection with the information systems of the suppliers and order the inventory whenever the inventory falls into a critical level. They put an order entry to the supplier without the intervention of the employees at all. So this is what the accounting softwares have introduced in the accounting data. The system has the advantage of providing inventory information, as we said, on a timely basis, but also requires the maintenance of a full set of inventory records. Still, we need to physically count the inventory. This doesn't mean that I will never go to the warehouse and check how many inventory I have left. The physical count of inventory will be performed also for audit uses, for audit purposes. I will have to number or count the inventory items and check if they correspond or are equal to the accounting value. If we have the same amount physically and in the accounting records, we have not made any mistake and our employees have been responsible. But if you find that something does not match, you have less inventory physically than is in accounting records, that means that either you have made a mistake in the accounting information or some employee has misused their responsibilities and their access to the warehouse. Again, relate this to what we mentioned before, that is the control of the inventory. It is performed or is carried out through the inventory equation. And how this works is through inventory counts. Then you compare that to the accounting value. Okay, I hope that is clear. Do you want a break now?
Yes.
Okay.
Definitely.
10 minutes break.
Thank you. For how many minutes? 多长时间休息
20 minutes.
20 minutes.
I think so. 10.
No, 10 no, diciamo, chiediamo quello lì.
Sì, io. Se voglio.
Sì, ma certo, ma prima chiediamo a lei quello lì del presentazione, no?
Ah, sì.
Are you ready? Everybody? Hopefully you can use this correction app. It's a correction app,
Yeah.
if you want.
Oh, you need.
Yes, it's like the
I use it, but it's like used so quickly.
oh yeah, okay.
Finished too quickly,
So
so
you
I
made-
changed.
Made a lot of mistakes.
Yeah, I always make mistakes.
我们问一下，然后就去咖啡
好，
泡子。
而且刚才我都没有顾得上要跟你说话来着。对，
根本就没有时间。
我去了。
回去。
Okay, usually our classes will be in the morning, will be more fresh, but not to talk and discuss with each other, but to understand, I think. And this is the only day that we'll have class in the afternoon. During the other days, we'll have class in the morning and tutorials in the afternoon, not every day tutorials, but some of the days, according to the schedule that you saw, okay? So, again, we are talking about the inventory standard. Why is that important? Because through inventory, many companies may try to impact their financial statements and financial results and to perform accounting cosmetics. I'm not saying accounting fraud because that's a very difficult word, but they try to manage earnings without violating any accounting standards or accounting law by just simply adjusting or changing the assumptions in the inventory cost flow. For example, we can change the gross profit. And remember what we said, gross profit is very important in comparing different companies with each other and understanding how good or bad they are performing in their sector. So once again, we discussed about 5 different cost flows. Which one of you can remember the 5 different cost flows? The unit cost, FIFO, LIFO, average, and base inventory. Okay, base inventory. Then again, we mentioned periodic and perpetual inventory system. Mainly, the perpetual system is being used currently by most companies because why? Because we may owe that to ourselves, having better accounting information system, powered by softwares and computers, we can keep track of many different items of inventory. But still, we have to count physically the inventory for purposes of control and auditing. Now, some definitions that we have under IS2. Inventories are assets held for sale in the normal course of business. They can either be trade inventory or finished goods in the form of materials or supplies to be consumed in the production process or in the rendering of services. These are definitions in the standard. Basically, they are the same words that we already use to describe inventory, but these are like formal definitions in the paragraph of the IS2 itself. Next, what we have to mention is that specifically excluded, therefore not included in the scope of IS2, are construction contracts. There is a separate standard that regulates and accounts for construction contracts. Then we have financial instruments. We have already covered with Professor Busso the financial instruments. And agricultural produce, we are going to talk tomorrow about that. Agricultural produce, it is IS 41, a separate standard, covering for inventories for farms or other business entities that deal with agricultural or farm or animal resources. How to account for that? How can we calculate the cost of something that we have grown in our crops in the fields? Okay, we discuss tomorrow about the agricultural produce. Another test question, yeah?
Would you please move the chat window to the edges?
I tried to do that, but okay. Another test question, which of the following is not under the scope of IS2? Now, we mentioned that agricultural produce is being considered in a separate standard and explained tomorrow, not today. Now, grapes at a vineyard, grapes at a wine-producing entity, grapes used at a restaurant and catering services chain, none of the items. Now, this is grapes all the time, but used for different purposes. And the purpose is what matters. We have the same thing, but if we consider that inventory or not, this depends on what we use the thing for. Okay? A, why? I agree, so the first alternative is the right one. Why?
Because it's under agriculture, then in B and C we have the product, the goods.
Okay. Remember that IS2 considered inventory either merchandise or goods that we use in the normal course of business. Now, grapes at a wine producing entity is something that I use. So I use grapes to produce wine. Or grapes in a restaurant, I use grapes to produce a plate or a dish, something. But grape at a vineyard, it's not something that I use for another purpose. It's something that is the primary thing or the basic of the operation itself, if I may explain like that. So I think it's quite clear for everybody. Be careful when you see the name of the inventory or the item or the produce. That's not everything. The purpose is important. Why do you use that? Do you use that to produce something else? Do you use that to resell? Then it is an inventory. Or you are generating that thing. That is the agricultural produce that you are generating or you are producing. Okay, definitions, other definitions of inventory under the same standard. Another very important definition that we have to understand is the term naturalizable value. Now the standard, this is important to know, the standard asks us to measure inventory, the closing inventory at the end of the period, to measure the inventory at the lower between the cost and the naturalizable value. Now, I know what the cost is. The cost of inventory is what it costs me to purchase the inventory. And we mentioned that the cost of inventory includes the purchase price, the transportation costs, the custom costs, and so on. But what is the naturalizable value? The naturalizable value is the estimated selling price less any expenses that I have to incur in order to sell that inventory. In simple words, the net realizable value means what will I get in return from selling this inventory that I have. It is quite logical why the standard requires us to value the inventory at the lower between cost and net realizable value. Because we have to be prudent. You have heard in accounting there is a prudence concept. This means that we do not have to advance our profits. We have to be the more conservative as we can. This means that if we can anticipate any loss, we have to record in the period when we anticipate the loss. If we anticipate that a certain inventory will be selling at a lower price than it has been cost to us, then we have to record the loss that we incurred at the current period. Okay, this is the logic why IS2 requires us to compare the cost and the net realizable value and always to choose the lowest of the two. Okay? Why? Because in accounting, once again, we have what it is called the prudence concept. The prudence means that every moment, in every case, when you anticipate a loss, you have to record that loss now. You do not have to wait until the future period. You do not have to wait until that loss actually is realized in order to record. You have to record it now, okay?
What's the percentage?
Sorry?
What's the percentage of loss? Can we just assess that?
It can be 5 cents, but you have to still. It can even be 5 cents, but you have still to compare cost and net realizable value. The really important question, actually, it's not about the percentage or the amount of the difference between the two, but the basis in which we make the comparison. Now, the standard usually requires you to compare item by item. If you have 1,000 items of inventory, for example, Carrefour, you have to compare each item of inventory. Be careful, not each unit. That's a different thing. Each item of inventory. You have to compare each item, their cost with their net realizable value. It allows you to gather together in a group similar items. For example, all kinds of rice, all kinds of pasta, all kinds of water, and so on. But basically, you have to be very careful when you compare cost and net realizable value. There may be many conditions in the market that will tell you that probably the selling price of this inventory is going down, or the cost to complete the inventory is going up. Both cases will lead you to those instances when you have to realize a loss from writing down the inventory from cost to net realizable value. Okay, this was a long sentence, I'm repeating. There may be two cases that lead you to recognize a loss from writing down inventory from cost to net realizable value. One case is when the prices in the market, the selling prices, go down. For example, one of your friends mentioned the fashion products. When you have a decrease in the price of the fashion products, you will sell it with a lower price. That is a typical example when the net realizable value from selling a pair of glasses will be lower than the cost of producing these glasses, okay? Another instance is when the cost of completing the inventory or the production process goes up. And this, for example, may happen in the near future, right now, in the coming weeks or months. We are anticipating an energetic crisis. The prices of energy will go up, and together with that, many other prices, transportation and production, and many costs that are related to the manufacturing of inventory that is still work in progress will go up, and this may make many companies to decrease the value from the cost to the net realizable value, if you know what I mean. Is that clear for you? So these two instances are very common reasons why the companies should compare cost with net realizable value. Whenever they see that actually actually the net realizable value is lower than the cost, this will be recognized as an expense in the period when the loss is or the decrease in price is verified. Okay? If in the other period we can see that we have a reverse in the conditions that led us to recognize a lower net realizable value, that will not be considered as an income, but as a decrease in the prices and cost of inventory of that period. Everything that I'm saying is in the slides actually, so maybe it's easier if you follow. Okay, the cost of inventories includes these items. Whenever I'm talking too fast, please let me know. Okay, or when I'm talking and the slides are not following always, please let me know. The cost of inventories, remember, include the cost of purchases, the cost of conversion, or other costs that we incur in bringing the inventory to the present location and condition. For example, if you have to pay the transportation to bring the raw material from Milan to Turin, you have to include the transport cost in the cost of the raw material, and then subsequently in the cost of production. Also, if you have to put this inventory, the raw material, in the warehouse, you have to include the cost of the warehouse for the raw inventory only in the cost of inventory as well. So basically, logically, everything that you pay in order to make readily available this amount of inventory for its intended use, it is a cost of inventory, either production or purchase. Okay? Is that clear? There are many cases when you may wonder, do I include this in the cost of inventory? Only ask yourself, is this a cost that I have to pay in order to bring the inventory when I want it to be used in production? Actually, when we put the inventory, where we put the inventory in production is the production floor. All the costs that you pay until the moment that the raw inventory has arrived at the door of the warehouse basically is a cost of production, okay? So this is something simple that you may put in your mind and always think before you decide if one item should be included as a cost of inventory or not. This is about the cost of inventory, something that you may remember and is easy, is what is considered as part of cost of purchase. The purchase cost and the cost of purchase may seem like they are the same thing. They are not. The purchase cost over here, the first line, is the purchase price that you pay to the supplier only. But the purchase cost is not only the purchase price, but also includes, like I said, the transportation and handling costs, the import duties. These are actually taxes that are not refundable. But be careful, the value-added tax or the sales tax is not part of the cost of inventory, because usually the value-added tax is refundable by the state. Okay, so be aware. The duties or excise or other non-refundable taxation costs, they may be included as cost of inventory, but not value-added tax. Okay? Also, if you have trade discounts, do you know what trade discounts are? Or rebates? Rebates may be not a normal term, but trade discounts is quite familiar. What is a trade discount? I noticed someone that noted. It is simple, but just to steer a conversation or debate. Mm-hmm.
We make a discount.
For what purposes?
To
How do you get a discount, by the way? Can you just go purchase something and get a discount? There are different types of discount.
Membership discounts.
For the personal life, yes, but in terms of a company life, how do we get trade discounts?
When you buy a lot of products.
When you buy in big quantities, one reason. When? The other reason is when you belong to a special category of clients or customers, you have a long-term relationship with the company and they offer you reduction in prices, not only because because you are buying in large quantities, but because of your special relationship with the company. Another instance when you can get a discount is when you pay within the period of allowance, and that is sometimes called the sales discount. Usually you have a fixed term to pay an invoice, and if you pay within 10 days or 15 days, you are offered 2% or 3% discount on your invoice. So, I mean, there are many different cases when you can have a discount. Be careful, the trade discounts are not adding the cost, but are deducting the cost. So they are to be considered with a minus. Whenever I get a discount on the purchases, this is a lower cost to me. I mean, the transportation, the taxes will add to the purchase price, but the discounts will be deducted or subtracted from the price. That is fairly straightforward. Now, something that may require a little more time to understand is the conversion costs. Now, the cost of purchases is related to the merchandising companies. Actually, the merchandising companies are quite easy to handle. They do not produce anything. They just buy and resell. Sometimes they buy, they repackage, and they resell, but that's it. Whereas the manufacturing companies, they are really complicated because they buy raw material, raw inventory, and they produce finished products. Sometimes the finished products does have nothing to do with raw material, if you can imagine the details of manufacturing. So the conversion costs relates to the production of the inventory or to the manufacturing process. And the conversion costs is related to the units of production. For example, the direct labor. That means that the conversion cost includes not only the direct material or the raw material, but also items of costs that are needed to be expensed or incurred in our efforts to produce something. Again, the logic is the same, and remember this. I will consider as conversion cost every kind of cost or expense that I have to do in order to produce something. Direct labor is included in that. I don't know if this needs explanation. Direct labor is the cost that we pay to our employees, but not to all employees, but to those employees that work in the production floor. These employees are known as direct employees, and their labor is known as direct labor. I need to pay these employees in order to produce the product, the finished product, and that's why the direct labor is part of the conversion costs. Except for the direct labor, the standard requires you to allocate to the conversion cost also the production overheads. Now, this is where things become not complicated, but a little bit more complicated. Overheads are expenses that are usually incurred in the production floor, but are not direct material or direct labor. For example, in the plant or in the factory, we'll have electricity bill paid for. We'll have depreciation for machineries. We'll have maintainers for machineries. We'll have rent. We have to pay rent for the building, and so on. All these expenses that you spend or incur or charge for the plant itself during the production process are known as overheads. Now, overheads can be fixed and variable, and there are different bases for allocating them. The standard requires the fixed production overheads to be allocated based on a systematic way of normal capacity or long-term expected capacity, whereas the variable production overheads are to be allocated, related, or based to a actual use of facility and resources. Okay, now we have here all the rules. The allocation of variable overheads is based on actual production, whereas the allocation of the fixed overheads is based on the normal capacity. Now, what is the normal capacity? The actual capacity relates to the actual number of units that we have manufactured, whereas the normal capacity represents a long-term average number of units that I may produce or manufacture, considering the regular maintenance of machineries. I'm repeating once again. Considering the normal process of production, when I have to interrupt the process to perform maintenance to machineries, we may produce 10,000 units in the first year and 12,000 units in the second year and so on. The average, 11,000 units, is the normal capacity. It's what I produce as an average in the long run, considering not ideal conditions where I continually work without interrupting the process, but considering normal conditions of work. Employees get tired or make mistakes during their work. Machineries may need maintenance in order to work in a very good conditions of work. So this is the normal capacity, okay? So conversion costs, according to the standard, will include once again direct material, which is the raw inventory itself, direct labor, and overheads. Overheads are variable and fixed. The variable will be allocated based on the actual production. That means how many units did you actually produce in 2020, whereas the overhead, fixed overheads, will be allocated considering the normal capacity. How do we know the normal capacity? Each factory calculates the normal capacity and makes you know what is that.
Professor,
Any question?
the direct labor is, can you explain a little bit about
Okay.
that?
Actually, this is not something that, to be honest, this is not something that should be covered in the standard, because later on you may have another module known as cost accounting, and cost accounting will cover in detail how you calculate everything. So don't be afraid, I will not ask you to calculate the direct labor. It will be given as a data, as readily available to you. But to answer your question, the direct labor is the salary that we pay to our first line employees, to those employees that are directly connected with the manufacturing process. I have many employees in the plant, in the factory. Some of them are supervisors. Some of them are maintenance workers. Not all of them are direct labor. Only those employees that work as a directly or first line connection with the manufacturing process. This is something that will be provided as a data for you. How you actually calculate the direct labor, overheads, and so on. This is the scope of another accounting type that maybe you will study in the future, I don't know, and that is known as cost accounting. Here we are financial accounting, so no need to go more into details for that. Nevertheless, you will find in the textbook some example of covering the cost of inventory, and the tutorial that we are having together regarding inventory will cover how we calculate the cost of conversions. Okay. What IS2 says on fixed overheads, this is something that IS2 is very specific. It allows the use of the actual capacity if it approximates the normal capacity, but if the actual capacity is lower than normal capacity, the amount of unallocated overheads will be treated as an expense. Even though this is a focus or within the scope of cost accounting, IS2 is very specific what is allowed to be allocated to inventory and what is not. The problem arises when I have an actual capacity which differs a lot compared to the normal capacity. For example, the normal capacity may be 10,000 units, but my actual capacity for 2020 or 2021 was 5,000 units. So what do I do? What do I do with the cost of overcapacity? Is it fair that I allocate this cost to the units of production? That is no, because they do not have to keep the charge of unused capacity. That is not, let's say, the fault of those inventory items. That is why IS2 requires that the cost of unused capacity will be expensed as an expense in the current period, and we allocate to the current inventory that you produce only the cost of the used capacity. Another problem arises when I have the actual capacity abnormally higher compared to the normal capacity. What happens in those cases? In those instances, the standard requires you to calculate lower cost of inventory. Okay, that is fine and normal when you have over produced, but not when you have under capacity. Again, an example on the allocation of fixed overheads we'll see in the tutorial together. The last thing about cost of inventory is that we may have other item of costs that are permitted by the standard to be included in the conversion cost of inventory. And these usually are costs that are incurred in the process of bringing the inventories to their present location and condition. Costs which cannot be included in any case are those that are listed over here. Under no circumstances you can include these items in the cost of inventory. This is not allowed by the standard. You may calculate or allocate these items, but this will not be considered acceptable. For example, this one is abnormal amounts of waste. What are wastes? If I can ask you, what do you understand with this concept, waste? What are wastes? We may have normal amount of waste. They are perfectly fine with normal conditions of producing stuff. Waste are materials or inventories that are wasted during the production. I cannot reuse them. For example, if I have some fabric and I want to cut a shirt out of this fabric, I will have some left pieces, and that is waste, and that is perfectly normal. So for each production process, I have normal percentages of waste, but sometimes I may have abnormal amount of waste, and this happens in those cases when, first, my employees are not trained, they don't know how to cut the pieces, and they waste the material and the fabric. Or sometimes this happens when the machinery goes broke and it just destroys all the materials that I have. In these cases, this abnormal amount of waste, I should not allocate their cost to the inventory. This is not fair. I should regard that as an expenditure or a loss for the period. Something not normal happened, the machineries or the equipment went crazy and they destroyed the fabric, but this is not a fault to be borne by the cost of inventory. They should be recognized as a loss for the period. So this is one example. Another example is the storage costs. After you have completed the production, you take the finished goods to the warehouse and you wait until you sell that product. The storage costs are not going to be included as part of the cost of inventory. Why? Because you have already completed the production process. You are waiting to sell that product, that inventory, okay? So remember, one question, is there any exception to that? You have the answer there. The exception is the storage cost of raw materials if it is in a high amount. That means that if I need to put the raw materials somewhere until I put it in the production process, that is okay to be included in the cost of conversion, but not the cost of storage of the finished product, but only of the raw material. And also, this is logical, the administrative and selling costs, they are not going to be considered inventory costs. What may be an administrative overhead? The salary that you pay to the audit company, for example, to Deloitte or to KPMG that audits your financial statements, that is administrative overhead. It has nothing to do with the production process. It should not be included in the inventory cost. Or the selling cost, you pay some cost for advertising. You pay cost for advertising in a social network. This has nothing to do with producing the inventory. This has, a lot of connection with trying to sell the inventory, but not with producing that. So logically, you are making this division. Everything that you spend trying to produce or manufacturing the inventory is going to be considered a conversion cost. Everything that does not have a connection with producing or manufacturing is not part of the inventory cost. This is like a logical division between two categories that you may remember. Okay, again, another test question. Which of the following is not to be included as inventory cost? It can be more than one answer, so I'm taking them one by one. Again, inventory costs are everything that I spend trying to purchase raw material and produce and manufacture finished products. Salary of manufacturing supervisor at a manufacturing facility, is that going to be considered as inventory cost? Yes, because it is spent trying to manufacture the product. Electricity bill for the headquarters. This is for general administrative of the company. It does not have anything to do with production process. Electricity bill for the manufacturing companies. Yes. Transportation cost of raw materials into the entity. Yes, transportation cost is part of the cost of purchase. Cost of purchase is included in the cost of conversion. Transportation cost of the finished goods to the customer. No. Production has finished. Now you are taking your product to the customer. This is distribution cost or selling cost, but not inventory. The standard prohibits you very distinctly from including this cost in the inventory. Repairing cost of manufacturing line due to unplanned work shortages.
Yes.
What do you think about this one? Repairing cost, repairing and regular maintenance is allowed, but not irregular, unplanned. These are wastes that should not are abnormal. They should not be included in the cost of inventory. Ordinary maintenance costs, yes, but not abnormal. Unplanned, no. Custom taxes paid on purchase of materials. Yes, because they are not reimbursable or refundable by the government. Insurance fee paid for premises of finished goods warehouse. Okay, it's one keyword there that makes it easier. Finished goods. What happens after the completion of production? Whatever happens later, it's not my problem. It should not be included in the conversion costs. Okay. So now, last one. So notes are in bold, and you can see that. Some techniques for the measurement of the cost of production. Again, this is something that we have also mentioned before, the unit cost and the standard cost. Usually many companies may follow the first approach. What the unit cost implies is that in order to measure the cost of inventory, I base my calculation to the actual figures. Okay, but these may become sometimes very fluctuating and may give very different amounts of inventory costs. If you know what I mean. Are you tired? Yes. A little bit more theory and then we'll stop the exercise. It will be easier to focus, but please let's try some more minutes to understand what we are saying. The unit cost. It means that we calculate the cost based on the actual figures. Let me explain with simple words. The cost will vary from one month to the other because we have differences in various items. Different cost of transportation, different custom costs, different cost of purchasing the materials, and this will give me different cost of inventory. And this is not very helpful for managing companies. It means that, for example, this bottle of water, when I produce that during summer, will cost less because in summer I pay less electricity. Whereas the same bottle of water produced during winter, when I pay more electricity, and remember, electricity manufacturing process should be allocated to the inventory, it will cost more, but it's the same inventory, nothing has changed. So many companies do not follow the unit cost. They do not base their calculation onto the actual figures. Instead, they base their calculations to some normalized and some weighted amounts that are known as standard cost. What is the standard cost of purchasing raw material? What is the standard cost of paying for a kilowatt hour of energy? What is the standard cost of paying for salary for employees? I may pay him more. The employees who work overtime will get paid more, but we have a standard cost of employees or direct labor. So basing our calculation in standard cost system gives us a consistent cost of inventory that is more reliable to use and more informative. It doesn't change, it doesn't fluctuate over time, and it's easier to use for analysis purposes. Actually, many companies use the standard cost system, and they analyze the differences only to be at the end of the period. At the end of the year, they see if they have any differences between actual and standard costs, and they deal with these differences. It makes it easier for many companies to calculate the cost of inventory. Imagine for yourself, if I follow the standard cost system, I will make the calculations based on some standards that I have pre-calculated, and then only at the end of the year I will think about the differences. Whereas if I follow the actual realized cost, it will make me think all the day, every day, what is the cost, why is they differing, and this is really time consuming for many companies. So this is why you will find very often the use of the standard cost by many companies. The third one is something that I mentioned at the beginning of our lecture today. This is the retail method that is used by the merchandising companies. For example, Carrefour, what they basically do is that they refer to the final selling price and they deduct or lower this price with a profit margin that is normal for their sector. And they come up with the cost that they use as cost of sales. This is very useful, very practical for these kind of companies. And you will find that it's used both by merchandising or retailing companies. We have another question: which entities are more likely to use the unit cost method? Construction companies, entities that manufacture products customized according to customers' specifics, or furniture, for example, service providers, special entities, banks, insurance, or whatever. Okay? Sorry, I think I speak very fast. We need, I think, to have an answer for each of them. Which entities are more likely to use the unit cost? Construction companies? Yes or no? Entities that manufacture products? Yes. Service providers? Yes. Special entities, if you think of banks or insurance companies? Batch manufacturing companies usually use standardized cost method, and also the companies that provide different services like internet connection, phone lines, and so on. Something else about the cost of inventory, there are some rules under IS2 regarding the cost formulas for the determination of the value of the inventory and the cost of goods sold. The cost of inventories of items that are not ordinary, interchangeable, and goods and services produced and segregated for specific projects shall be assigned by using specific identification of their individual costs. This is the method of unit cost. The cost of other inventories shall be measured by FIFO or weighted average. And as a final result, we mentioned LIFO method is not allowed under ISO. Again, what IS2 says about net realizable value. As we mentioned, it is the estimated selling price in the ordinary course of business less the estimated cost of completion and the estimated cost necessary to make the sale. Remember that inventory should be measured at the lower, always between cost and net realizable value. The amount of any write-down on inventories to net realizable value will be recognized as an expense in the period when the write-down occurs. The accounting policies adopted in measuring inventories, including the cost formulas used, should be disclosed as required by IS2 for the cost of inventory. Other disclosures that are required are, for example, total carrying amount of inventories and the carrying amount in classifications appropriate to the enterprise. The carrying amount of inventories that are carried at fair value less cost to staff. The amount of any write-down of inventories that is recognized as an expense. Now, why I mention the disclosures for cost of inventory is that during the preparation of your course or group work project, you have to check the inventory not only in the face of the financial statements, balance sheet, and the cost of inventory in the profit and loss, but also in the notes of the financial statements. And when you have the reference number that links you to the part of the inventory, you should read carefully the information, what it says about inventory. What part of inventory is being written down or reducing value from cost to the net realizable value. You should look this in the financial statements and include in your group work project. Okay? That's why I'm mentioning that. This is another test question actually. You can read through the information in the meanwhile. Did you cover with Professor Busov the events after the reporting dates? Even after balance sheet date, did you cover in the first time? No.
No.
Okay, just say no. These are events that happen after 31st of December. Okay, let me explain very briefly. Class, it's not difficult. Events after the reporting date are important events that happen after 31st of December, but before the publication of financial statements. The accounting year closes at 31st of December, whereas the publication of financial statements may happen in May or June 1 of the following year. In the meantime, there may happen some very important stuff, and the company should disclose this information. Okay? Now, keep in mind that these are known as events after reporting period. What we have here is an entity that reports a financial statement on 31st. On 31st of December, the value of item X of inventory was $10,000 and this was its cost. Actually, the entity applies IS and values its inventories at the lower between cost and net realizable value. At the end of the year, the net realizable value was defined to be 9,000, and therefore entity A revalued, wrote down the cost of inventory to 9,000. But 2 weeks after that, on 14th of January, inventory X was sold at 7,000, so even lower than the net realizable value. Once the decreasing trend begins, it doesn't stop. Now, entity alpha finalizes the financial statement on 14th of February. That means that what happened on 14th of January happens before the finalization or the publication of financial statements. It is considered an event after the reporting period and should be disclosed in financial statements. It means that if you close the balance sheet and you assume or pretend that nothing happened, you are not being fair to your investors. if you know what I mean. So the IAS and IFRS require you to disclose all the important information that might change the opinion of potential investors, even though this happened after 31st of December. It seems fair, right? So what is the amount that company would present in its financial statements for inventory X? 10,000? No, because we know that IS2 requires lower between cost and net realizable value. Cost 10,000, net realizable value 9,000, 10,000 is not true. Now it is between 9,000 or 7,000 or none of the above. Any opinion? Use the common reason, common logic.
7,000.
What should be disclosed for the best decision-making potential for investors? Now, this is the final, the ultimate reason why we prepare financial information and why we follow financial reporting standards. In order to have more informative decision-making power for our investors. This is the ultimate purpose. Okay, keep this in mind.
9,000 nominal value.
7,000.
9.
9.
7.
Okay, let's assume 9. We have some answers in the chat. Hopefully, B, D. Okay.
We have both.
Let's assume 9,000. I will assume as your friend here 9,000. Okay? You are showing to me I'm a potential investor. Whenever I see that you are not attentive, I will put the question in the test. But please pay attention because this is important. Let's assume that we disclose inventory at 9,000 and I am a potential investor that I buy shares from your company. If I see inventory 9,000, this makes the company look better than it really is and may misguide my decision. Actually, the truth is that the inventory of the company is obsolete, is not economically sound. And I have to know that before I buy the shares for your company. How do I know that if you don't disclose that fact? So the fairest thing and the most honest thing to do, and actually this is what is required by the standards, the IFRS, is to value the inventory at 7,000. Okay, and to recognize as a loss as 3,000 for the current year. This will give more information to the potential investors. Okay? So it is alternative C. I'm sorry for Mustafa and Ivan. It's not D, it's not B, it's C. Again, all the test questions have been questions in previous years, so you can know what we expect. This is the final slide, and you made it for the first lecture. Congratulations. But still, we are not done. We have to make the short example. Now, in the end of each lecture, I will include a slide that will guide you what to do in that group project that you are doing, what to include for the specific chapter. For example, we covered inventory today. What shall we do about inventory? You'll have a look at the financial statements and you will analyze and put in the slides what are the rules that the company is following. You may have, I don't know, your companies, Carrefour, Peugeot, some of one that I saw. What are the rules of measurement and what are the disclosures about inventory? And prepare a short summary. A short summary doesn't mean that you have to spend 3 hours to do that. A short summary means that you may prepare 2 or 3 slides talking about inventory. For example, Peugeot has classified inventory 1, 2, 3. The value at the end of 2020 is this one. The written down value is this one. The expense for 2020 is this one, and so on. Okay? Not unnecessary details. All I want you to do is to have some time and check in the financial statements the part from the inventories and to understand more. Is that clear? I will do this for every chapter. The last slide will guide you what to do in your group project regarding the chapter. Okay. You already read the last slide, right? This information is ready for you. Good.
Esatto, sì, sì.
I really hope that you can see the students in class. I hope you will see the screen. And also I hope the students online can see now the Excel spreadsheet that I have prepared. Okay. This is an exercise that I have expanded from the textbook. It is exercise 1 at page 380. There are 2 products there, but only one we are going to cover and solve right now. Have no more than 5 minutes reading through the information and maybe talking to each other a little bit just to have some break. And then after 5 minutes, we'll solve this exercise together, okay?
Pianos. It's just section of the year you know average time only, so people don't have the grand required cosa devo fare, magari da calcolare da FIFO, che ne so. O da calcolare profit, visto che lì c'è buy, purchase, sale.
Can I ask you a question? You can turn me without the microphone, right?
A little bit, not that,
Okay.
yeah.
How many of you have studied, before coming to this MBA class, how many of you have studied FIFO and weighted average method before? Please don't be shy. I know. Okay.
Only heard, no exercise about it. Only heard during the national degree.
You didn't actually make any calculations how to perform it. Okay? So I see that the majority have not. Okay. At first I was thinking, should I include this exercise? Maybe you will get bored with it, but now I see that this is the right thing to do. Okay. Did you read the information?
Yeah.
Okay. We are required to calculate, to prepare a statement that shows gross profit and closing inventory valuation for FIFO and weighted average, only for one item of inventory. Actually, this company buys and sells 2 standard types, but we are going to cover only one here. Actually, in reality, companies buy and sell thousands of products every day. But now we try to learn the logic, not the big amount of transactions, just the logic, how we calculate the cost of ending inventory, the cost of sales, and the gross profit under each method. Okay, I have a new sheet over here, which is solution. All the Excel files that are generated during the class will be uploaded in Moodle. You can, of course, keep your notes in your notebooks. You can use the Excel files to get familiarized and so on. But remember that maybe depending on the type of the exam that you'll have, maybe you will not be able to use Excel. You have to learn how to solve the exercise not in Excel. Okay, even though we are using this method. Can we start that? Any idea how to start the solution? Suggestions are welcomed. So what we do? open another file, another sheet called solution. And what we do there? The first method, it is the FIFA method. Okay. In order to be easier for me, I'm copying the information regarding the dates and the purchase price and the selling price. Okay? Please try to follow me in a notebook writing the solution. It will be very easy to write in the white table, but it's not easy for your friends at home to follow us that way. So maybe this is why we use Excel. Now this is the information that we have, and the first one that we use is the FIFA method. What we do under this method, remember, we sell what we have bought or purchased first. And the ending inventory at the end of the period is represented by what we have purchased at more recent dates, more recently. Now, in order to calculate the inventory cost, we have to keep track of the units and costs. Both are very important in calculating or applying the methods. You have to keep track of two different things in the same time. You always have to know in the warehouse, in the storage room, how many units do you have and how much do they cost. So both of them you have to keep track of, okay, in every method that you apply. Now, we are in 1st of January, we have purchased, we assume that 1st of January we have no unit at hand in inventory. We start with a purchase, so 0 inventory at the beginning. We purchase 4 units at 400 euro. That is, what is the inventory at hand at the warehouse? How many units?
4.
Okay, when we say inventory at hand, this means inventory level at the warehouse. Okay? It is 4 units. And what is their cost?
400.
Now it's difficult to follow this keyboard.
1,600
Okay.
euros.
What is their cost? We have 4 units. Each of them is purchased with 400 euro. That is, their cost is 1,600 euro. Okay, I'm adding another column right here. That is the calculations. What is the calculations for units? At 400 each. I apologize, but it is not easy with this keyboard. So every time that we purchase something, this will change, we said, the cost, depending on the type of the inventory cost flow that we follow, okay? And 31st of March, here we have the first sale of our inventory, and we sell 1 unit. We have had 4 units at hand. After we sell 1, how much is left in the inventory? That is simple. We have 4, out 1, we have 3 left. What is their cost? Remember FIFA method. That means that what we had at hand at 31st of March is what we have purchased recently. This is quite easy because we have only 1 purchase, but it may become more complicated later. These 3 units are equal with each of them 400. That means 3 units at 400 each. Okay? Now we have purchased 1 unit with a higher price. Sorry, with a lower price. Now I see it. We are in a situation of slight deflation or prices decrease. Now, what is the number of units that we have on hand? 4. Now, what is their cost? Let's be consistent. We have 3 units at 400. Yes, good. Plus what?
1 at 350.
Okay. Okay.
1,500.
That means that,
1,550.
sorry, I can barely see the,
1,100.
this is right, but I can barely see the keyboard. Okay, so the cost at 30th of April is 1,550. Again, this is not something difficult or complicated, it just needs a lot of focus to follow the inventory flow and to keep track what is going on, and it should be easy.
Yes.
Now, after this, we sell one other item. How many units do we have left? 3 units. We had 4, we sell 1, we have 3 left. Good. Now, which units do we have left? Which one did we sell?
400.
Remember that we had
400.
3 at 400, we had 1 at 350. Which one of them did we sell? What does FIFA says?
Very small.
The most earliest one. So I sold one that was costing 400. That means I have left 2 units at 400 plus 1 unit.
At 350.
Was this understandable?
Yeah.
Okay, it's easy as I said. I just want to make sure that we understand. So again, 800 plus 0. I'm just putting the calculations immediately, not with formulas. I apologize for that, but the keyboard is not really, it reflects on the light. I cannot see anything here. So I'm just calculating with my mind. Again, at 31st of July, we buy 2 other units at 300. You know how many units do we have now in the warehouse? We have 3, 2 come in, and then we have, this means we have 5. Good. How do we value or calculate their cost?
2 units at 400 or 1 unit at 350?
We have 2 units at 400,
And 1 unit at
1 unit
350?
at 350,
And 2 at 350.
plus 2 units, the one that I recently just purchased, 2 units at 300. So this is the explanation of the inventory composition at each date. Again, it's not complicated, except for the fact that you should be really focused and follow the flow of inventory. But again, this is not done by manually by each one, but accounting software keeps track of this data. So 150 plus, it should be 1,750. Good. Then we sell 3 units. How many units do we have left?
2.
2. Now which is their value?
360.
First thing first, I mean that what I have left in the warehouse are the recently purchased.
2 units at
This means that these 3 units that I sold were 2 units that I purchased in January 400 plus 1 unit left from purchases of April. Or, to put it simply, first in first out says that what I have left is what I recently purchased. What I purchased recently. 2 units with 300, that means their cost is 600. Sorry, I'm copying and pasting a lot, but still, I have a very difficult keyboard here. Okay? Any questions so far? No. I purchased another batch at November, 1 unit, so this means that I have 3 units at hand right now. What is their cost? The existing cost of inventory is 600 plus 250. Their cost is 850. That means that the explanation or the composition of inventory, it is 2 units at 300 plus 1 unit at the recent price 250. I think that this is not, FIFA method is not difficult. We can understand, we can calculate everything, okay? Now, the weighted average method is also not difficult, but it has slightly more calculations to do. But it is basically the same logical flow. You have to follow the inventory. But the follow-up becomes a little bit more simple with the average method. Now, with the average method, I'm doing the same thing. I'm taking the information about purchasing and selling, and again, I have to keep track of inventory, either in units and in cost as well. And the calculations or information, I will put in another column right there. Again, don't be distracted by what we did in FIFA method. Let's focus in average method and let's think together what happens. Every time that we purchase some inventory, we have to calculate the new weighted average cost of inventory. That brings to my mind that this is not a simple average method, but weighted average. There is a difference between simple and weighted. Okay, let's start. We purchased in 1st of January. We have 4 units at 400. How many units do we have at hand? Now that we purchased 4 units. What is their cost for by 4? 1,000 and 4 units at 400. Okay? We sell 1 unit by 600. How many units do we have at hand left? 3. Okay. What is their cost? 1,200. 3 units at 400. Okay? Now, till this moment it's simple. Now we purchase another batch, another part, another group of inventory. We have 4 units at hand. What is their cost? We have 3 units purchased with 400 plus 1 unit purchased with 300. If we make the calculation, it is this cost of inventory. Again, this is the total cost of 4 units of inventory, okay? For the moment, if we make a comparison between FIFA and average, we have the same cost of inventory for the moment, okay? But what is different here? At the moment that I calculate that the total cost of 4 units is 1,550, I can calculate the weighted average cost as the division between the total cost and the total number of units. That is 1,500 euro. If I divide this amount with 4 units, this will give me an average cost. Let me calculate. This will give me this average cost, 387.5 euro. Now this is something that we didn't perform as a calculation at the FIFA method. It didn't matter over there because I was following the inventory flow. Whereas at the average cost, whenever I have some new product entering the warehouse or the storage room, I have to remake my calculations with the new products that are coming in. How much is the cost of inventory in our warehouse? Right now, before we purchased the second batch, the cost was 400 euro. Now that we purchased the second batch with 350, the weighted average cost, you can see, that became 387.5. It is an average between 350 and 400, but it's not a simple average, it's a weighted average. You see the meaning of the name here? Okay, is it necessary to repeat or is okay? So again, each time that you purchase some new batch, some new group of products, you have to recalculate the weighted average cost of inventory. We'll do that again later because we have another purchase in July. Now we come at the first sale after recalculating the cost of inventory. We are selling 1 unit and the selling price is 600 euro, we say that this is not important because it is decided by the market. We focus at how much did it cost to make this one unit that I'm selling. Now, after selling one unit, I'm left with 3 units at hand, okay? How much is the cost of 3 units that I have left in the inventory? The weighted average cost is this one over here. This means that in the warehouse, every single unit of inventory costs 387.5. How much do they cost 3 units? Each one? 387.5? 3 of them, how much? Now you are completely tired. Again, this is the figure in bold and underlined. It is the weighted average cost of 1 unit of inventory. Okay? How much is the cost of 3 units? The purchase price for this bottle is €1. How much is the purchase price for 3 bottles?
Multiple 3.
Multiple 3.
Multiple
Yes,
3.
you are tired. So again, these are 3 units and the weighted average price per unit that we calculated. This is the cost of inventory after we sell at the end of July. We are left with 3 units and each of them will be valued, will be costed using the weighted average cost of inventory. Any questions so far? Should I repeat what we did? I think that we'll do with the purchase of 30 June here and 31st of July here. Now that we purchased 2 units with 300 euro each, how many units do we have in inventory?
5.
5, 6. Okay. Which is the situation? Which is the cost of inventory at this moment?
We have 3.
How much do these 5 units cost in total? Not average, not yet. Total.
1,000.
Which is the situation? Well, we have 3 units at 387.5, but plus 2 units and 300. Good. This means that the total cost right now is 1,762.5.
We need
Okay. Are
recalculate.
we following?
Yes.
Okay. What should we do now? Now that we
Recalculate.
put some new stuff in, we have to recalculate the weighted cost,
The
the weighted average cost.
Yes.
How much is the weighted cost, weighted average cost right now? The total cost
Divide
divided
5.
by the total number of units.
Yes.
You see here, I have a different cost. And as the prices are decreasing, are going down, so is doing also the weighted average cost. How we calculated that? 1,762.5
Divided 5.
divided by 5 units. Weighted average cost. Now that we sell 3 units, how many units do we have left?
2.
2. How much do they cost?
2.
Again, one costs, how is there? How much
Multiple
costs
2.
of them? Okay, so it is this amount that we have here multiplied by 2 units, and the cost
705.
is 705 euros. Okay, again, there are 2 units at the weighted average price 352.5 euro per unit. Okay, Are we finished here?
No.
We have another purchase on 13 November. This is the last update that we have to make to the cost of inventory. How many units do we have left? Three right now. What is the total cost of these units? First of all, we have 2 units at 352 point each plus 1 unit at 150. Again, this is, I'm just calculating, 955. Okay? Let's calculate the last weighted average cost of inventory at the end of November, and we finish for this year and for today. Okay. So it is 955 divided by 3.
300.
We have this new weighted average cost of inventory. Again, how did we do that? Total cost divided by total number of units, and we calculate the weighted average cost of inventory. You can see that it is continually changing, and you can also see that the weighted average method requires some more calculation than just the FIFO method, okay?
Yes.
Are you tired? But we are not finished yet. Can you give me 2 more minutes? Okay? But to be effective and to finish in 2 minutes, you have to focus for 2 minutes, or we will be here for 10 minutes. What do you know? Okay. We have to calculate, remember, we have to calculate the cost of sales and gross profit for each method. Remember? So we have FIFO and the weighted average method over here. We start with sales. From the sales, we subtract or we deduct the cost of sales, okay? Remember, cost of sales is opening inventory plus purchases less closing inventory, and this gives me the cost of sales. Whereas the difference between sales and cost of sales gives us the gross profit. Now, how much are the sales? Remember that whatever method you use, the sales and the purchases are the same. They do not depend on what method you use. They depend on the market. What you sell and what you purchase depend on the prices in the market. Now, the value of sales is 1 unit at 600 plus 1 unit at 600 plus 3 units at 500, 1,500, okay. The sales are 2,700, okay. And the same amount is the weighted average method. How did you calculate it? Once again, we sold 2 units at 600 and 3 units at 500. Okay, I'm writing here. This is the income or the revenue from sales. Opening inventory is 0 in both cases. How much are the purchases? Again, the purchases are the same, whatever the method. I'm purchasing 4 units for 400 plus 1 unit for 350 plus 2 for 300 plus 1 for 250. If I had used the number format of the cell, it would be a simple sum automatic right here, but I didn't do that, so I'm just calculating. Correct me if I'm doing this wrong. Now, what is the closing inventory that we have to keep track of? Both methods have provided us with a closing inventory. It's this information right here. At the end of November, I have 3 units. These 3 units under the FIFO method cost 850. Okay? Whereas these 3 units under the weighted average method cost 955. 955. So this means that cost of goods sold is opening inventory plus the purchases less the closing inventory. The cost of goods sold is 1,950 under FIFO and 1,845 under weighted average method. Again, what we did, cost of goods sold is opening inventory plus purchases less closing inventory, and we calculate cost of goods sold. Gross profit, by the way, how we calculate that? This is simple.
Sales minus
Okay.
cost of
The difference between sales and cost of goods sold. The gross profit under FIFO is 750, and after weighted average method, it's 855. I will upload this exercise on Moodle. Go through that again. We'll have the chance to go through the same type of exercise in tutorial classes. Okay? Again, what is important is to understand the logic, not to be lost in the mechanics of calculations. Okay? Homework for you. Think about the second question over here. When prices decrease over time, which one of the methods is more useful? This is a situation when we have a decrease in prices, okay? Either in the purchase prices or in the selling prices.
Weighted average?
Take some time to think about that, sorry?
Weighted average?
Both methods. Which one is more useful?
Weighted average.
I'm not expecting such a quick answer. I'll see you tomorrow morning, okay?
Yeah.
Thank you for the questions.
Thank you. Any more questions? Questo pum abbonamento. 만약에出去了的声音嘛，一个
对，
砰砰砰砰砰砰砰。
进每次一开电脑就
对对对对对，进来也是，对对对对对。
对。